Today, we're uncovering what gaps are and how you can use them in your trading strategy. First off, what is a gap? In trading, a gap is where the stock price jumps up or down on the chart, with no trading in between. It's like skipping a step on a staircase. There are several types of gaps. Breakaway gaps signal the start of a new trend. Exhaustion gaps suggest a trend might be ending. Measuring gaps, also known as runaway gaps, hint at the continuation of a trend. And then, there are common gaps, which are usually not significant. Why do gaps get filled? Often, it's due to traders taking profits or reacting to new information, causing the price to move back and fill the gap. Volume is crucial in gap trading. A gap with high volume can indicate stronger market interest and a higher likelihood of continuation in that direction. Here are some quick tips for trading gaps. Always consider the context, like current market trends and news. Be cautious. Not all gaps fill immediately. And use stop-loss orders to manage your risk. And that's it. Gaps can be powerful indicators in trading, offering insights into market psychology and potential opportunities. Remember, always do your research and trade wisely. Like this quick guide? Subscribe for more insights and happy trading.